Joe, welcome to the Strong Wealth Podcast. I'm excited to chat today. I really appreciate your time. I think you're one of the most articulate Bitcoiners that I've met, talking through macro, Bitcoin, your market price action, all of the above. It really shows that you spend a lot of time thinking about this stuff, writing about this stuff. I know from your Bitcoin layer days, I think you spent a lot of time writing about it, especially. So I'm excited to pick your brain about what's going on in macro markets in Bitcoin today. I'd love to start with just what's going on in the stock market, man. It feels like it's very disconnected from reality, in my opinion. And, is this really a distortion of fiat that we're seeing here? Because, the reality is on the surface that Hormuz still appears to be closed. The Iran conflict continues to go on, even though Trump says he's got it under control. We've won already. Doesn't seem that way on the surface. And he continues to, taco, if you will, every single time the 10-year gets above 4.4%. So I don't really want to go down the 10-year route yet, but it seems like the stock market just continues to chug along no matter what's going on. So what's your opinion on this?
Yeah, this is a really great question. And it kind of speaks to the way that the market has been pricing in the odds of the Strait of Hormuz opening and the war ending. In my mind, that's one of the main reasons that we saw equities rally so hard. Since the beginning of the year, more specifically since the start of the war, what you saw initially was in the first month, February 28th onward, equities sell off really, really hard. Bitcoin was up it's still up about 25% to 30% from the low, which was, or from the start of the war. So it is actually the best performing macro asset, even after equities had their record shattering rally. So they were up 11%, I believe, in 11 days, or they went from their sell off to a brand new all time high in 11 days, which is the fastest since 1972, which is wild. So, basically what that was pricing in my mind was an end to the war. And as the war has trudged on and Trump has sort of tacoed, if you will, where, he's saying, we're going to end the war. The war is wrapped up. It's going to last like a week. His entire cabinet is saying this too. Scott Bessent is saying, oh, it's going to be like 2 or 3 more weeks. And then it doesn't. The market is beginning to price in a little bit more uncertainty. So, like, obviously, markets are forward discounting mechanisms. When the war ends, Strait of Hormuz opens, oil prices go down. That obviously is a boon for risk taking. So, investors are trying to get in ahead of that. But as the war has gone on, it's been abundantly clear that it's probably not going to end anytime soon, unfortunately. And a lot of the inflationary shock as a result of the Strait of Hormuz being closed due to causing extremely high oil prices and the ripple effect that'll have through the economy is already priced in. So now you're beginning to see the S&P 500 sell off, the NASDAQ sell off, Bitcoin largely holding steady. It's down a little bit. I mean, it's 80,000 at the time of recording. By the time we upload, might be 70. Who knows? But in my mind, now they're starting to price in the fact that this war may be going on for sooner than we thought, and the effects of inflation are beginning to ripple throughout the economy. Reason I say that, you saw this morning's CPI print. I think everybody listening to this has heard about it at this point. Highest price inflation level since 2022, right? Not exactly ideal, particularly for an administration whose entire premise, apart from no wars, was that inflation would be kept low. So now, like, Trump does not have the inflation in his corner, right? He does not have disinflation anymore. Now we have accelerating inflation, which is not what you want. That's a result of the oil prices. And it's going to get worse because there's a lagged effect between the Strait of Hormuz being closed to its impact on oil prices, then its impact on fertilizer, LNG, diesel, gasoline, all of the downstream products as a result of that. So the inflation is basically locked in, if you want to think about it that way, for the next 6, 12, maybe even 18 months, depending on how long this thing goes. And so, like, he doesn't have the disinflation in his corner anymore. He started a new war, which is something that he promised he wouldn't do. And the only thing he has left in his corner is asset prices. So in my mind, like, thinking of this from a 4D chess perspective, okay, what does Trump have left? Well, CPI is at 3.8%. What he can do in the next couple of months is either reopen the straits, sign a peace deal with Iran, get the heck out of there, don't put boots on the ground, and pray that by midterms that causes disinflation and inflation comes back down to 3%. He can say, hey, I ended the war, peace in the Middle East, whatever, prices are down, whatever. Maybe the stars can align on that end. And then in the event that that does happen, asset prices do well. Scenario number 2 is that the war continues raging on. which would mean the only thing that he has left in his corner that the Republicans, the incumbents, have left in their corner going into midterms if they don't want to be swept by the Dems. Because as much as I hate talking politics, all of this is political, particularly now with Kevin Warsh, Trump's pick, being installed as Fed chair in just 3 days, this Friday, May 15th. Ultimately, they have a huge outsized impact on asset prices. So really the only other thing that would be going in the Republicans' corner is asset prices. And so if the war rages on and inflation continues getting worse as a result of the strait continuing to be closed, then you don't have no new wars, you don't have disinflation. What do you have? Asset prices. So you do whatever you can in your power to juice asset prices into the stratosphere. You almost have a bit of and so in that situation, even if we see a massive recession, an inflationary recession, demand destruction that comes as a result of huge gas prices, I would expect major stimulus, right? It's a great cop out to give stimulus, creating an inflationary recession. It's also a great reason to cut rates, right? Even though it wouldn't have any impact on price inflation, because this is entirely driven by oil. It's not driven by consumers being too overheated. So changing policy rates at the Fed level won't actually do anything, but it will juice asset prices. It will get the wealth effect going, and it will get people buying things again. So in either of those scenarios, I see Bitcoin doing extremely well into end of year. We're at a really critical juncture right now. We've made 2 attempts at breaking above 83K. On the third attempt, if we can't make it, I'd say we're probably heading lower, unfortunately. But by November, given this is the last lever for Trump to pull, I say that it's the most likely lever for him to pull. And whether the war ends or it doesn't end, those are the two situations in my mind that he would go about doing it. So that's sort of the way I'm viewing markets now. To sort of bring it back to your original point, which is like, is the stock market completely disconnected from reality? I think to an extent they were, but more so they were just pricing in an end to the war. They were being very optimistic. They were buying what Trump was saying, and I was too, to some degree. But now that the CPI inflation is hit, it doesn't really matter what Trump is saying or the end of the war. The inflation's already baked in. Equities are pricing it in. And so if this thing doesn't close up soon, I would envision a lot more pain throughout the summer, a lot of demand destruction, potentially a recession. But you and I both know on the other side of recession, massive printing.
So are you trying to trade this, potential, I won't say crash necessarily, but it seems like there's really this kind of air bubble, or this air pocket here that has happened with, complacency in markets around the Iran war and the Strait of Hormuz being closed. Now reality is starting to set in, to your point of, we got the high inflation print, and, the Strait of Hormuz is still closed as of now, really. And it seems like we're keeping it closed now for some reason. I don't really know what these moves are, but we'll see. So it sounds like your view then is summer may not be so fun, but, we all know on the back of asset prices dropping is more money printing coming.
Correct,
Is that fair to
exactly. So
say?
that's very fair to say. As far as like active trading, what I've done now as the war has escalated and this has heated up, particularly with the hantavirus as well, during 2020, I was a freshman in college. I wasn't active in markets like I am today. And so seeing this seeing this happen, seeing the first cases in the United States occur, I have bought some extremely out of the money put options on the S&P 500 and the NASDAQ. So literal lottery tickets. I don't do a lot of short-term trading or swing trading, but that's what I've put in place so I can get a nice payday in the event that we do see sort of a 0 to 1 black swan event. But as far as other active trading, I have layered a bunch of bids on Bitcoin all the way down to the lows. Because, frankly, there is a lot of support for Bitcoin all the way back down to 60,000. And we've already crossed a few critical junctures for the asset in my mind. Number one, we've crossed the short-term holder cost basis and the true market mean. The true market mean is basically, like, you can think of it as the average purchase price for basically all Bitcoin on the network. It does a little bit better than other measures of cost basis because it excludes old coins that haven't moved in a very long time, and known lost wallets. And so basically, that's a really good level to think of as a support and resistance level, right? If we break back above that, chances are there's a really high likelihood of holding it because people are going to try to defend their cost basis and average down. But if we break underneath it, and we break underneath the short-term holder cost basis, which tends to be another floor that's set during bull markets, then it would be very, very telling, and it would tell me that Bitcoin is likely headed for lower lows. But we've already broken above that. We've also broken above the ETF cost basis, which is about $80,000. So the average price at which the ETF cohort purchased their Bitcoin, obviously, the ETF assets all have different prices, but mechanistically they have a cost basis because the entity has to purchase the underlying, which is around $80,000. We've broken above that as well. So the third juncture in my mind that's sort of sitting above Bitcoin right now, that's preventing us from moving into a bull market, excluding the macro factors, which are obviously are shaping up to not be in Bitcoin's favor for the time being, is the 200-day moving average. This has been one of the most reliable indicators as far as whether Bitcoin is in a bull or bear market. And it's at 83K. It's dropping by the day, of course, but it's at 83K. And every single time Bitcoin has broken above this level and held for at least 4 weeks, that has marked the end of the bull market, or the end of the bear market. Now, that said, we obviously have this confluence of negative macro factors, but at the same time, we also have and so to the downside, that's sort of how I'm looking at things, also how I'm positioned. But also, on the flip side, as far as factors that are very supportive of Bitcoin, this Thursday we have the Senate Banking Committee reviewing the Clarity Act and potentially passing it. That would be very bullish into the summer, in my opinion. Once the Senate Banking Committee reviews it, it has to go before the Senate, then it has to go before the Senate Agriculture Committee, then it has to go before the full House, then it has to go to the president's desk. So there's still a lot of steps. But ideally, and also think about this from a political lens too. As I mentioned, Trump doesn't have the disinflation anymore. He doesn't have the no new wars. All he has is asset prices. Younger voters, right? The constituents that are going to matter to the Republican Party over the next several decades, they're heavily allocated to Bitcoin and other crypto, quote unquote, unfortunately. But, this is an act that would be extremely supportive of that. Given the fact that he doesn't have anything else in his corner other than asset prices, and Bitcoin is so important to younger constituents, it stands to reason he would try to get this thing passed into law as soon as possible. Tim Scott and a couple of other senators and a couple of people who work in the White House have said July 4th is the targeted date to get that thing signed. So we'll see. That's a huge tailwind for Bitcoin's price. Big unlock there in my mind. It would sort of break down the barrier of perception for Bitcoin as an asset, if you will. It would also foster a lot of stablecoin adoption. It has protections for self-custody in there. Haven't read the full thing, but I intend to do it this afternoon because the final text just got revealed, and I'm really, really excited to dive into that. But that's one tailwind in Bitcoin's quarter. Another tailwind is, of course, Kevin Warsh this Friday, but like all of it in my mind is butting up against this ugly reality of this oil shock, and like you just can't get around it. You just can't. Like we are facing the biggest oil shortage globally since 1973, and in 1973 you had gas lines. My mother talks about how back in 1973, they had to pump gas on either an even or an odd day. Like everyone was assigned a number. You could only get so many gallons. Ultimately, what we're facing now, as far as a global daily oil shortage and the rate at which we're depleting our extra reserves, is faster than 1973 on an energy per capita basis. So if this continues much longer, it's not going to be very pretty. Like, the last thing I'll say here, and we can talk about this a little bit more, is the U.S. is never going to run out of oil. That will not happen. We have plenty of West Texas crude, right? But the unfortunate reality is we can't pump it at $30 a barrel or $40 a barrel. We have to pump it at 70, 80, 90, 100. It's much more expensive than importing it from the Middle East. And so we're not going to run out of oil, but there is a level at which it reaches where every downstream product, not just gasoline or diesel, becomes prohibitively expensive for the average consumer. You see people start cutting back, and then you see a recession. So we're not quite there yet, but all of these favorable macro factors for Bitcoin are butting up against the macro reality of this oil shock into the summer.
Want to retire soon, but you're unsure how to manage Bitcoin volatility, avoid selling your stack, and generate income from your portfolio? Imagine heading into retirement knowing that no matter what Bitcoin does next, runs to new highs, drops 60%, or chops sideways for years, you're good. Your income is secure, your stack is intact, and you're not losing sleep over it. That's what Strong Wealth offers retiring Bitcoiners like you. Book a free discovery call today at strongwealth.net to find out what retirement can look like with the right plan supporting it. Go to strongwealth.net. Now back to the show. So we have the commodity spike driving up prices. We're seeing the inflation, is high. We've already seen it at the pump, for our gas prices, and it looks like this inflation is not going anywhere because of all of the things that you described. And to your point, the Fed doesn't seem like they have any levers to pull at this point. It seems like Trump's only lever, based on what you said, is to print money and keep asset prices inflated. But they would be then printing money into the commodity spike that's driving all of this inflation, oil, fertilizer, and the supply chain disruptions that we've seen with the Strait of Hormuz. So that seems like it's only going to hurt the average American,
Yeah.
even more if they're printing money while we're seeing this supply chain disruption. So how does that play out for not only the average consumer, but how does that affect more broadly the bond market? Because if we're seeing higher, than expected inflation and it's expected to stick around for a long time, and then their only response is to pour gasoline on that inflation fire with
Mhm.
money printing, what's going to happen to the bond market and what is their response going to be? Because, the other factor in this is Kevin Warsh coming in here in a few days. And he has said that, he's not a fan of QE. It seems like he is positioning himself to cut rates, but, that money printing he may not be on board for. And they can't really raise rates either. So they're between a rock and a hard place here. And if they do decide to go ahead uh, uh, choose the money printing button again, like they've always done before when there is crises and reason to do it, what's that going to do to the bond market, and what do you feel like their response is going to be?
For sure. It's a really good question. And ultimately, the reaction to the bond market is not going to be a good one. You've started seeing over the last month or so, yields tick up quite a bit. The 10-year, I believe, is up 13 basis points. The 2-year is up 20 basis points. So, um, rate hike expectations have increased. Growth and inflation expectations have also increased. And so there's this really interesting dynamic at play where obviously whenever tensions escalate, whenever the S&P 500 has a bad day, Trump and everybody else gets out and tries to talk markets down. They try to jawbone their way into markets doing well. But ultimately, like, the bond market is the most truthful market out there because all it is pricing in these things. The ability for the government to repay its obligations and the risk premium associated with owning a piece of government debt. Whereas with equities, they are a forward discounting mechanism, but they're also pricing in risks specifically to that company. The U.S. Treasury market is not only the largest globally liquid sovereign debt market in the world, but it's just a pure reflection of expectations for the U.S. economy and the U.S. government over these different periods. So with that said, what the bond market is telling you is that the Strait of Hormuz remaining closed, that's going to be horrible for inflation expectations. Investors on a longer time horizon want to be compensated at a higher level than what they're being compensated at now. And so that's effectively what the 10-year going up is telling you. Right now, it's at 4.5%, 4.45%, up 13 basis points in the last month. And so ultimately, as a result of that, it becomes very difficult for the U.S. government to finance its own debt. The interest burden has already grown to the one of the largest line items on our balance sheet. And so, in order to manage that, there's a lot of job owning going on and trying to basically keep the 10-year below that 4.5% level. I don't know specifically why that level is so important. I would just wager that it's a very critical level as far as their debt is concerned because it's the highest yield on the 10-year since 2018, which is quite crazy if you think about it, because obviously the Fed has begun cutting rates. They've begun expanding their balance sheet once again. Yet the 10-year is the highest it's been in several years since even before the Fed began its last hiking cycle, if I'm not mistaken. I may be wrong on that. But either way, what it's telling you is the bond market is pricing in massive inflation expectations and pushing yields to such a high level that it would become very difficult, if not untenable, for the U.S. government to finance its debt using increased tax revenue, using new bond sales, right, which is the true definition of a Ponzi scheme. Um, and so ultimately, like, what that would lead to is the Fed needing to step in and monetize the debt, which is not ideal at all. And that's fancy speak for buying the U.S. Treasury's debt using our very own central bank with freshly printed money. well, technically buying off the run treasuries from banks. But who knows? If it gets really hairy, you might see the Fed step in at treasury auctions, which actually has happened. I believe they stepped in at an auction last month or the month before. I'm not sure. Um, but either way, like the mechanism is still the same. Freshly printed money is being created and spat out into the economy. And ultimately, what that looks like is a snake eating its own tail in Ouroboros. Obviously, beyond some point, with the Fed, with our own central bank printing money to buy our very own government debt, a snake eating its own tail. Ultimately, what that leads to is the snake eventually reaching its own head and dying. So that's sort of the situation that the U.S. Treasury wants to avoid, and that's why Trump is trying to jawbone the end of the war as much as he can to keep yields from spiking too high. But there's only so much you can do before yields explode much higher as a result of the inflationary shock that is already underway as a result of oil.
So do you think Warsh is going to play ball though, and step in and do yield curve control, or because he'd be going against everything that he said leading up to this
hmm
point of QE is reverse Robin Hood, stealing from the poor to give to the rich. That's one of his most famous sayings, and
hmm
I know that he approved QE back in the day. I think in 2010, following the great financial crisis. But is he going to play ball this time? It seems like he wants to play ball with rates and cutting rates and listening to Trump there. But is he also going to expand the Fed balance sheet when he said that he wants a smaller balance sheet for the Fed?
For sure. I don't think so, at least not at first. And I think it's going to cause, like, this is the interesting thing. I think rates are going to come down. It's not going to have an impact on inflation because, as we discussed, this is not consumer driven inflation. It's entirely oil driven inflation. I think rates are going to come down in order to make it easier for the consumer to access credit, loosen up lending standards, and sort of ease the pain on the other side of this oil inflation. Um, but I don't think QE is going to happen, at least not right away. And this is the reason why. Obviously, Kevin Warsh has said that QE is reverse Robin Hood, stealing from the poor to give to the rich. Um, and so I think that rates will come down very soon. I think they'll come down this summer out of necessity. And I think he will try to pull basically every lever he can before expanding the balance sheet. That said, we're already expanding the balance sheet at a pace of $40 billion per month. I don't think that's going to stop. Historically, if you look back through time, uh, every time the Fed has begun doing like a small program to expand its balance sheet, take the end of 2019, for example, when we had the cash shortage in the repo market, we began expanding our balance sheet by, I think, $26 billion a month. That was the stated cadence, and it didn't slow down. It ramped up marginally until March of 2020 hit, and then we had a massive print. And then it didn't slow down until several years later. So, like, the order of operations is a slow expansion of the balance sheet. Something happens because it's not enough, and then a rapid expansion of the balance sheet followed by tapering. Um, and so we're sort of not at phase two yet. So I think we'll keep the 40 billion cadence. If anything, we'll increase it once push comes to shove. I don't think QE will be the immediate lever that gets pulled. I think Warsh is also going to be very vocal about not wanting to do QE and feeling like he is forced to. I think the only situation in which he does QE, like outright balance sheet expansion, buying assets from banks, off the run treasuries, etc., is in the event that there is really no other option. Like in the event that, let's say, the hantavirus explodes and all of a sudden, we're back to global lockdowns. I think more than half the United States would reject that, though. So I don't think that that's a lever they can really pull. Let's say like for some reason, some black swan event occurs. I think in that situation, really what you have to do and what historical precedent suggests is you print money, right? The emergency response time for the Fed has only grown shorter. So I think in a true emergency situation, Kevin Warsh would bite his tongue and go for it. That said, I think it's going to be much more difficult for him to expand the balance sheet than it was for Powell to do so. He willfully did so twice. And so, I think the lever that he's going to pull is interest rates until something occurs or there really is no other option on the table, such as an inflationary recession. And then at that point, he will look to the balance sheet as the other lever that he can pull because really those are the only tools that are in the Fed's tool chest. I mean, they do have other facilities like the Bank Term Funding Program, for example, back in 2023, where it's not money printing per se. It is a temporary lending facility where banks can go to the Fed. This was after the 2023 banking crisis in March. 3 years ago now. Crazy to think. My goodness, time flies. Where banks could take their distressed U.S. Treasuries, bring them to the Fed, receive full par value on them, and then eventually pay them back over time with no interest. So uh, that was a stimulus program for banks that wasn't exactly money printing. It was sort of a sweetheart loan facility. So I think they'll try to do some sneaky stuff like that isn't technically outright balance sheet expansion. It's not technically money printing before they ultimately have to do quantitative easing. And in the event that they do, I don't think that's what they'll call it, right? Because optics matter quite a bit. So long-winded answer, but I think like to summarize, interest rates, policy rates rather, are the lever that Warsh is going to pull. It's going to be his favorite thing to do, particularly heading into the summer with the demand destruction we're about to see. It'll be really important to take some of that burden off the consumer's back. And then if push comes to shove, we'll try to create other facilities, other programs that are not outright asset purchase programs, but they're loan facilities. And then like the very, very last thing we will try to do, the final lever that we will pull, and I think it will happen at some point during Warsh's tenure if the math necessitates it, is QE. But I think that's sort of the last thing that he'll consider doing.
Sounds like he needs a little bit more pain to
Yeah.
justify actually doing it, and so maybe the war itself is not enough, but we might get some something later this year. To your point,
Yep.
so we'll see. Hopefully, this the whole hantavirus thing is not COVID 2.0, because to your
Yeah.
point, I don't think that'll fly over like it did the first time.
Oh no. But hey, it would be a field day to people with a lot of cash sitting on the sidelines. Like we've seen this playbook before, literally go all in. But we'll see. I
Yeah.
would not say no to some new stimulus checks, even though I know it's my tax money being regurgitated back at me. I would not say no.
Yeah, I wouldn't say no as a asset manager for our clients either. I
Yeah.
feel like that'd be a fun time to be alive, both to the downside and then what in the response back to the upside. But just everything that we're describing here, it really feels like a perfect storm for Bitcoin to perform very well. But I've also felt like 2025 was a perfect storm for Bitcoin and the start of 2026 so far. It feels like macro has really been the perfect setup for Bitcoin to shine, to be honest. And it just really hasn't. 2025 was a very disappointing, bull run by Bitcoin standards. We ended the year down somewhat like 7%, if I remember correctly.
Yeah.
And I think it really surprised a lot of people because what Bitcoiners were hoping for actually turned out to be, actually turned out to happen in gold. And it seemed to me, at least like that time, like maybe real money, institutional capital, large pools of capital are still looking at gold as that kind of safe haven, neutral reserve asset that Bitcoiners have been shouting, from the rooftops for so long that should be Bitcoin, and it just hasn't been yet. So why, in your opinion, do you feel like this is going to finally turn around for Bitcoin and it will shine through all of this, macro chaos? Or are we going to see again disappointing performance during a time when theoretically Bitcoin should be the highest performing asset?
It's a really great question. Like ultimately, first things first, like nobody knows what's going to happen, unfortunately. The best thing that we can do as analysts, as money managers, whether you're running your own money or someone else's, is to be probabilistic, right? And sort of weigh the different scenarios. And in my view, what we're heading toward is either a wall or, a clear and open skies. And it's sort of what I explained earlier, where the biggest story in macro right now is the Strait of Hormuz. It's been closed for almost 3 months. It runs 20% of the world's oil supply, and it has an outsized impact on price beyond that 20% share because it exports extremely cheap oil, right? Not just oil, but other oil exports, like natural gas, fertilizer, etc. And so the longer that remains closed, the more hairy the macro situation gets, the higher of the likelihood that instead of the gates opening and us moving straight through, we hit a wall and then the Fed is forced to print a bunch of money. So really two scenarios in my mind are playing out because all of this is coming to a head. The first is that the war ends sooner than later. The floodgates open. We see some acute inflation, but in order to offset it, we see rates come down in order to give a little bit of easiness back to the consumer. And we might see a little bit of balance sheet expansion. We might see some asset purchases from banks in order to get the risk-taking machine going back on. The second situation is that the war doesn't end anytime soon. We hit a wall. and asset prices drop. You see a correlation to one event similar to March 13th of 2020, though not to the same extent, I don't think. And you see, you have sort of a final capitulatory bottom for Bitcoin and all asset prices, right? Because even though gold is a traditional safe haven, people are always going to seek liquidity during times of crises. And if we hit the wall, gold is going to sell off too. But I believe that similarly to the way Bitcoin has been the best performing asset since the start of the war, I believe that in the event of that occurring, it would also be the best performing asset from the bottom, right? It would be the first and fastest to recover. Reason I say that so confidently is it was the case in 2020. And of course, it was the case. It has been the case since the beginning of this war. So even though Bitcoin's cross-asset correlations do not suggest that it's fully decoupled from risk assets just yet, its R squared to the Nasdaq is still quite high. At the margin, it's beginning to behave a little bit differently. You got to think with all of this institutional capital now coming online for Bitcoin with the passage of the Clarity Act in particular, but also over the last 2 years as some endowments have begun dabbling in the Bitcoin ETFs like Harvard and Brown, et cetera. You got to think like looking at when you're constructing a portfolio, and you know this better than I do, like looking at the start of the war and saying, okay, what's the best performing major macro asset? As far as liquidity is concerned, talking about major, that's how we judge it, I suppose. And then also like on a percentage basis, what has it done? Bitcoin's up 25%. The Nasdaq is up 11 or 12%. The S&P is up 9%. Gold is up, I believe 7 or 8%. So Bitcoin has shined during this crisis, and it's also shined during the prior 6 crises as far as geopolitical crises are concerned. Whether it was the first, the Iran war that we had, the 10-day war last summer, crazy that we've had 2 in the span of less than a year, the COVID shock, the March 2023 banking crisis, each of these events, 60 days after the fact, the last 7 of them, Bitcoin was up 7 out of 7 times. And relative to gold and the S&P 500, it was up by more than each of them. Whereas gold was only up 5 times, the S&P was up 6 times. And so what that tells me is like the longer that Bitcoin behaves that way, the more that its cross-asset correlations over time become a self-reinforcing feedback loop. It behaves this way. Money managers see that and then begin allocating to Bitcoin with the expectation that it will outperform following a crisis, right? So it doesn't trade that way yet, to be very clear. It's extremely volatile. It's not exactly what you want in a safe haven asset. You want one that can go up reliably over time, but especially during crises. It's like the least correlated asset. That's what you want. And the fact that Bitcoin is now sort of playing that role of being the best performing asset following crises, but at the same time, it has that tech component where it's very high beta to the market and it goes up when times are good. That tells me that Bitcoin is slowly but surely becoming a risk-off asset, a safe haven asset. And each of these is sort of this moniker is sort of defined by the least correlated asset in markets. We're not quite there yet. We'll be there for the next several years, maybe a decade, 2 decades plus. But the reality is that at the margin, these events help support that case, and it begins becoming sort of a self-reinforcing feedback loop, if you will.
I want to challenge you a little bit though, because yes, it may have been the best performing asset since the start of the war, but we also, if we look prior to the war,
That's right.
obviously Bitcoin had already fallen 50% and nothing else did. I mean, yeah, we saw that kind of crazy week in gold and silver at the end of January, but even those did not fall anywhere near as much as Bitcoin did.
Yeah.
And so, yes, while we have seen it perform since the start of the war, prior to that, it also fell much more than everything
Mhm.
else. So, I don't know. I'm a little bit confused maybe as to what happened in 2025 ending to 2026. I mean, what do you feel like was the driver of was it poor performance? I don't know. We still got a decent all-time high right on cue, if you
What
will.
caused Bitcoin to suddenly crash on October 6th? With no basis
I,
of it.
I don't. I mean, I don't know if it was just that though. I mean, we never saw
Mhm.
a kind of blow off top in Bitcoin, and then we got this 50% dump while everything else was hanging near all time highs. And so yeah, it's come back a little bit, but here we are at 80,000, while everything else is hitting fresh all time highs. So I guess just looking backwards a little bit, I know we've been looking forwards. I want to hear your diagnosis on what caused 2025 and the start of 2026 with Bitcoin. Why did we
Yeah.
not see the strong performance that we've seen historically, despite the incredible tailwinds from macro, from Trump, the red wave. Like, why didn't we see it, in your opinion?
For sure. In my mind, it's entirely a function of global liquidity. And so when I talk about global liquidity, I mean bond market volatility, the absolute level of yields, and then the actual price of US Treasuries. And if you put all three together, one of my favorite metrics for this is specifically at the Bitcoin layer. I didn't create this metric, this was after I left, but it's called TBL liquidity. Basically, it takes those three factors, combines them together, and then it can tell you with a pretty good degree of certainty whether liquidity conditions are expanding or contracting. So whether they are positive or neutral, specifically for Bitcoin. Right around the end of last year, late September, early October timeframe, liquidity conditions began contracting. That is to say, bond volatility began rising. The absolute level of interest rates began rising as well. And of course, treasury prices falling in tandem with that as a result. Um, and so Bitcoin topped within a week or two of liquidity beginning to contract. Um, Also, this sort of plays back into what I mentioned earlier with like the fact that Bitcoin is still correlated to the risk bucket. On October 6th, when Bitcoin topped, IGV also topped. It's a software ETF, and many of other single name software equities also topped and began a monumental sell off that moved well into the beginning of this year. So, had it not been for Bitcoin's tech correlation, if it already traded like this, uncorrelated asset, that wouldn't have been the case. But unfortunately, I believe it was just caught up in this massive de-risking event, right? Maybe the de-risking was entirely due to global liquidity contracting. Maybe it was due to people looking at tensions rising in the Middle East. I don't think it was the latter. I think it was almost entirely the former, just a massive de-risking in software names. And unfortunately, the money that trades Bitcoin like software. That would be, in my mind, the simplest explanation for it. We have seen Bitcoin, and the reason I say that, we have seen Bitcoin native sell-offs in the past where it's entirely just Bitcoin in a vacuum selling off while every other name does well. But if you look at its cross-asset correlations, like this occurred in tandem with a software sell-off. So for me, it's just a function of global liquidity contracting and a market-wide de-risking. And unfortunately, Bitcoin gets bundled in with the risk bucket. So it is a bit unfair to say, yeah, look at Bitcoin has done so well since the start of the war when it was already down 50%, right? There's not much more you can go down. There's really only one way to go once Bitcoin drops by 45, 50%. So, ultimately, like that's sort of the story as to why it underperformed leading into the end of 2025. And as far as like Bitcoin not really having a blow off top, I think ultimately my thinking on that was because, well, and this until last year, my thinking on that was, well, Bitcoin is growing into a more mature asset. The dominant cohort is increasingly the ETF class. And, ETF holders tend to not be buying and selling Bitcoin or any asset in their portfolio with high frequency. Therefore, it's something they allocate to and don't really think about, and it's going to lead to lower volatility for Bitcoin. That's what I thought, right? It's a larger asset, more mature, what have you. Um, and that explained why Bitcoin didn't have the blow off top. But then gold had a blow off top. It added what, $10 trillion in a month and a half, 2 months. So that sort of threw the entire idea that you can't have blow off tops in large assets or mature assets, because we know that that gold is historically a much less volatile asset than Bitcoin, yet it behaved like a meme stock, right? But without the crash, So that sort of threw that narrative out the window for Bitcoin. Look, I ultimately think the reason Bitcoin didn't have a blow off top is sort of because of that exact dynamic I explained a moment ago, where this is an asset that's still trying to find its identity. It's still trying to find its footing. It's moving from extreme speculative tech to an asset that people want to passively allocate to for some high beta. And then the next phase will be an entirely uncorrelated asset that behaves more like gold. We're sort of in that awkward middle right now, where retail doesn't necessarily dominate the market anymore. So you don't have these huge derivatives driven blow off tops where Bitcoin goes from, like in 2017, 10,000 to 15 to 20 within the span of like 2 or 3 months. Or in 2021, where we go from 20 to 45 to 60 and then back down to 40 in the span of like 4 or 5 months. Because it's not dominated by derivatives and retail anymore, it's increasingly not going to have that behavior. But at the same time, because we're still connected to the risk bucket, and we're not entirely correlated to gold, or uncorrelated from anything just yet, it also doesn't participate in those massive rallies that commodities have, particularly during times like this where there's extreme uncertainty. So I would dub what's happening right now as far as Bitcoin's cross asset correlations during its monetization as the awkward middle, where you can't necessarily get those blow off tops, but by the same token, you can't participate in the major rallies that take place in other assets. So that's sort of my explanation, if I had to give one, as far as Bitcoin's underperformance for last year. And yeah, looking ahead, I'd say I don't want to say clear skies, but I'll call it a supportive backdrop for Bitcoin, and a number of scenarios in which Bitcoin could do well this year, and ideally, do do a little bit better than 2025. We don't want 2 red years in a row.
That would not be fun, but I think you did hit the nail on the head. I think a misconception with Bitcoin is when you're saying that it's it's global liquidity driven. I think what a lot of people think, and you may have been the source of this, but the M2 money supply
Yeah.
correlation. I know that went out the window. I
Uh-huh.
think a misconception is that just because global liquidity is rising, that Bitcoin should be rising. And really, Bitcoin is mostly driven by the marginal liquidity in the system. And so, we know just by the definition of fiat that there has to be that introduction of new capital consistently in order to keep the system afloat. And so that inflation, that's why we have the 2% inflation target. It has to continue to increase over time. But Bitcoin is largely driven by the liquidity at the margins, and we did see the liquidity at the
Yeah.
margins. It wasn't really increasing that much in 2025. It was going up a little bit, but it was still pretty a slow increase. And then we did see that rollover in the start of Q4, which was exactly where, to your point, software stocks and Bitcoin rolled over. And I think we saw the run in commodities because of the macro forces at play, and it was primarily central bank driven. They were saying they were wanting to be less dollar dependent because of um the administration's goals of reshoring industry. They wanted the US dollar to remain the reserve currency, but they didn't at the same time. And we've
Mhm.
already seen this kind of transition away from the dollar already, really accelerated by Biden's sanctioning of Russia back in 2022. So central bank reserves, largely have been increased or have been shifted from dollar assets to gold assets. And so
Mhm.
I think the macro backdrop went to gold because it was central bank driven, but liquidity was not really along with that in order for Bitcoin to experience the same thing that gold did. And so I think what we could see, and you can tell me what you think about this, but I think what we're going to see here, maybe in the second half of 2026, is both largely running at the same time. I think commodities are still going to continue to run
Mhm.
because of these macro forces, but then the marginal liquidity that will be coming into the system because of what you described earlier of the dysfunction in the bond market, and really Trump's hands are tied, and the Fed's hands will be tied as well. We're going to see all hard assets at the same time increase substantially, hopefully.
Yeah.
We'll see if that happens. Do you think that is what's going to happen, or do you see it differently? Obviously, in the short term, it's a little bit more difficult to predict, and it seems like
Yeah.
you're feeling like there's going to be a lot of pain here over the next few months. But as we finish out 2026, do you feel like we're going to see hard assets really shine, both commodities and Bitcoin at the same time, instead of what happened in 2025, or something different?
I really like the way that you framed it. Like, Bitcoin is a liquidity driven asset. Macro forces and central bank balance sheets really drive gold. I do agree with your thinking that both will rise in tandem this year. And here's why. Like, number one, you have extreme geopolitical uncertainty, central banks allocating to the asset itself, and of course, central banks expanding their balance sheets, which is a huge boon to gold, right? Massive boon to gold. Of course, if we do enter into an inflationary recession that is kicked off by a massive sell-off across all assets, it's very sudden. then everything will sell off, right? But the first to recover will be the two assets that recover and perform the best, in my mind, will be gold and Bitcoin. So that's component number one. Component number two is liquidity. That's what drives Bitcoin largely. It is funny. I was the one that created that chart initially, so I committed the cardinal sin. The original sin, if you will, of putting the overlay between the two assets. But it turned out to be spurious in the long run. But ultimately, they were going together for like 21 months. And when you see something like that, and you see M2 being a leading indicator, you can't help but lend that a little bit of credence. It turns out, in hindsight, the reason that that was the case was because China's liquidity was expanding to a tremendous degree. And the United States was also expanding to a tremendous degree. But once U.S. liquidity began contracting, once Chinese liquidity began contracting, but U.S. M2 was still expanding, that led to the correlation breaking, right? So it wasn't actually a correlation at all. But so ultimately that's a little bit unfortunate. But speaking specifically of liquidity, to your second point, why could Bitcoin do well? Like liquidity, as far as TVL defines it, is sort of three attributes. Number one, as I mentioned, bond volatility. So the stability of the underlying collateral for basically all of global financial markets, the banking system, et cetera, namely U.S. Treasuries. So what is the MOVE index doing? Number two is banking assets. So what's on the balance sheet of these institutions to judge the capacity of banks to expand credit? As you just mentioned, we need 2% inflation because we're in a credit-based monetary system. So if bank balance sheets are not healthy, liquidity conditions can't expand. Number three, is U.S. dollar strength, right? So this is the strength of the dollar relative to other currencies. So namely the Dixie index or BBDXY, the Bloomberg Dixie, which I prefer. What we're seeing right now is the dollar has been extremely volatile. It's had a really volatile year. It's down about 3% over the last year. It's up marginally since the start of the year, but really just rocky and super volatile. So that's not necessarily in liquidity's corner over the last couple of months in particular. We also have the MOVE index not doing quite well. You have the 10-year going up to 4.5% and going down and up and down as Trump tacos. So the MOVE index has also moved higher. And of course, the third rung on the liquidity sort of index is banking assets. Now, this is the one thing that, particularly as of recently, has been in Bitcoin's corner, which is that the Fed is expanding its balance sheet by $40 billion. So the way I see this shaking out, I don't see bond volatility lightening up over the next couple of months as a result of the oil shock, but also the fact that I think we're going to be in Iran for a little while longer than I initially anticipated. But number two, I think that banking assets and the strength of the U.S. dollar, banking assets are going to rise because obviously we're expanding the balance sheet, and banks may need more support as the war trudges on. But we also have the U.S. dollar, which in my mind, because this sort of ties back in the beginning what we were talking about, Warsh is going to cut rates. I believe, when push comes to shove, I think it's going to be the primary lever he uses, and cutting rates is obviously going to weaken the dollar at the margin relative to other currencies, depending on interest rate parity, right? Where we're at relative to other currencies and if we're cutting faster. So those two things move in liquidity's corner. And so that's why I think Bitcoin could do quite well throughout this year. But again, like it all boils down to when. It's just a question of when and what happens first. So do we get a correlation to one event as a result of either hantavirus or this oil shock that causes an inflationary recession and everything sells off and then we move higher? Or do we see the Iran war ease up? We see a lot of inflation throughout the summer, but not quite recessionary level demand destruction. Asset prices do well. That's sort of the main question for me in my mind right now. I think Bitcoin and gold both end the year higher than they are now. It's just a question of when, and that question is answered by which of these things happens first. Does the Iran war end in the next couple of weeks, or do we see this thing drag on throughout the summer?
Fair enough. I'm curious to get your take. So I feel like we could be entering another quote unquote lost decade in U.S. stocks. And I feel that way for a number of reasons. And we saw that in the 2000s after the dot-com bubble crashed. And I'm curious if you agree with this. We're seeing, obviously people steering away, or people, I should say, we're seeing other countries steering away from U.S. dollar assets. I feel like with this geopolitical tensions, and we're going to see like maybe a selling of U.S. assets held by foreign institutions. So, equity assets in particular get sold off because they, again, just don't want to be, overexposed to U.S. dollar assets. We're also seeing we're shifting from a unipolar to multipolar world,
Mhm.
where the U.S. was the dominant superpower of the last 40 to 60 years or so, and we're seeing that shift. And I think the two big signposts of that maybe are the Russia Ukraine war. We tried to step in and help Ukraine and didn't seem like we helped too much. And then also this Iran war is going to be over in a couple weeks, but now it seems like we don't have the same force that we may have had in the past. And so, supply chains are being reorganized. A lot of things are shifting here. And I feel like the U.S. is being brought back down to an even playing field with the rest of the world in some ways, and I'm not sure that it plays out very well for U.S. stocks over the foreseeable future. So, do you? I don't know. Maybe I'm off base, but how do you see the U.S. equity market playing out? Maybe over the next 5 to 10 years, do you feel like we're still going to be the superior economy, maybe of the world, and we'll see that reflected in the stock market? I mean, obviously, it's kind of hard to tell because money printing will distort,
Yeah.
what's going on. And so real returns versus nominal returns are very important clarification here. But with everything with how macro is kind of evolving over this time, do you feel like we're going to see another decade where international stocks significantly outperform US, gold significantly outperforms US stocks? Obviously, Bitcoin wasn't around back in 2000 to 2009 when this kind of last lost decade did happen. But Bitcoin could still shine, as we've already described. So, do you feel like that's possible with how things are shaping up here? I mean, I know it's kind of very hypothetical and long term and maybe hard to tell, but I feel like a lot of factors are pointing in that direction for me, and yet I still see so many people on Finance X. I want to call it Twitter every single time I
Yeah,
talk
me
about
too.
it. Still, RIP. But the VOO and chill cohort of the
Yeah.
finance, personal finance world, they seem all in on US and US tech, even maybe more specifically. So what's your opinion on that?
It's a really good question. I always tend to push back on the notion that the U.S. dollar is losing in its dominance. Reason being, central bank gold reserves are increasing as a percentage of total reserves globally relative to U.S. Treasuries. That said, what really matters, the bulk of what matters as far as U.S. dollar dominance is concerned, obviously, it's great if people hold our treasuries. It allows us to fund ourselves. And it, of course, ensures that U.S. dollar it remains the currency du jour of global trade. But the thing that matters more than that, and the real signal in my mind, is the dollar as a percentage of foreign exchange reserves, and the dollar as a percentage, or not as a foreign exchange reserves, of foreign exchange transactions. So the US
Mm.
dollar is still a larger percentage of FX reserves, even though gold has been gaining on it. But more importantly, the dollar as a share of actual FX transactions, global trade, has increased over the last 5 years. So for me, it's sort of it's an interesting play. To say I have a definitive answer would be lying. I really don't know, right? But I do think that the dollar is going to remain the world reserve currency, the dominant reserve currency over the next 5, 10 years. I think the US will remain the economic center of the world, and that's just because we have the most free and open markets. And as a result, I do think US equities are going to outperform international equities. That said, number one, it's not a bad idea to hedge yourself. It's never a bad idea to hedge yourself. Of course, we are moving into a multipolar world order. I think the US will still be the winner at the margin. That said, it's never a bad idea to allocate elsewhere. But I think the real winner over the next decade is gold and it is Bitcoin, right? With gold, you obviously have central banks allocating to it very aggressively. But I do think that they will find it's really difficult to settle international trade in gold. And ultimately, what you wind up doing is just reinventing fiat, reinventing the ledger system, saying, okay, I owe you X amount, you owe me Y amount. We put it on this ledger, we settle up at the end of whatever interval. So I think they're going to find it's really, really troublesome for doing what they wanted to do, which is be the asset that they hold in reserve for foreign exchange. Um, And number two, you still also have to have a currency that it settles in. If you can't settle in gold, then what currency are you settling in? They hold US treasuries because it's easy to convert them to cash when they need it, but it's not that easy to convert gold into cash when you need it. And also, too, what currency will you be converting it into? Will Russia gladly accept the Chinese yuan? Will China gladly accept the Russian ruble? When and if do you settle up? What will the currency pairs look like between those two? How will that war play out, right? Because they're allies now, but as they become more dominant trading partners with one another, what currency ultimately wins out, right? And I think that invite fighting will also drive a lot of demand for the US dollar, right? Because there's just way too much confusion and difficulty, and it introduces an entirely new can of worms. Like, look at BRICS. They've tried and they've failed to create this gold backed currency. They're still accumulating gold for their balance sheets. And so that's one of the reasons, including the geopolitical uncertainty, the liquidity expansion, money printing, et cetera, that gold will do extremely well. But I think for those same reasons, Bitcoin will do even better, right? Obviously, Bitcoin is more scarce, right? If we're talking about stock to flow ratios, as of the last halving, gold stock to flow ratio or Bitcoin stock to flow ratio is higher than gold. That's what you want in an asset that's absolutely scarce. But it also has the tech correlation, which for now, it's, in my mind, a good thing because of how well US tech is slated to perform over the next 5, 10, 15 years, right? If Bitcoin can maintain its high beta to US tech, then it is a global liquidity play, but also a high beta leveraged US equity play. So I kind of like it over the next decade. But that said, its chief function, its most important function is the fact that it's absolutely scarce. It has a lower supply schedule than gold and therefore a higher stock to flow ratio. So I think it'll win out at the margin. And then obviously, like the big one for me is that Bitcoin is earlier in its monetization journey than gold is. And so, therefore, I do think that it will outperform gold when you look at both on a relative basis. Bitcoin is a $1.6 trillion asset. I think gold is above 30 trillion now. I'm not exactly sure, but I think it's above $30 trillion. And so you have one that is literally just over 5% of the other, right? And so, in my mind, because Bitcoin's monetary properties win out over gold, both will do extremely well this decade. Like a lot of gold bugs and a lot of Bitcoiners like to denigrate one another. And the Bitcoiners say, oh, your time has come, Peter Schiff. And then Peter Schiff says, you guys are morons, tulip Ponzi. Like they're two assets that are trying to do the very same thing. And that is store value and preserve it through time. And they're the best assets to be invented for it. I think both will be the winners over the next decade. US tech will do great. It'll do marginally better than international equities, but Bitcoin will also will win out on a relative basis to gold because of the factors that I just outlined.
Fair enough. I guess we'll see how it plays out. Do you feel like there's anything that people aren't talking about that you're paying attention to that might end up being a bigger factor than it is right now? I know that's a very open-ended question, and you may not have an answer for it.
Yeah.
But if you do, it could be interesting. So, everybody, all eyes are on, obviously the Iran conflict, Warsh coming in. What is Trump going to do next? Is there going to be are we going to actually get this war over with and taken care of and reopen the Strait of Hormuz? And so that's, yes, it's the primary driver and that's where all eyes are. But is there anything else that you're looking at that you feel like is going to affect things, that other people aren't paying attention to or talking about right now?
Yeah, so people are paying attention to it and talking about it, but I don't think they're talking about the second and third order effects of it and what it will do to Bitcoin and other asset prices broadly, and how it will change the way people buy things. And that's AI. I made a video last week or 2 weeks ago, and the title was something like AI will replace you. It won't replace Bitcoin or something like that. And it was a bit hyperbolic, but basically the thesis of the video is that Bitcoin will be the asset for the AI era for two reasons. Number one, artificial intelligence, of course, has massive deflationary impacts. And basically what that's going to necessitate in a credit-based monetary system, we talk about the fact that it needs 2% inflation. Artificial intelligence driving down the cost of goods, driving down the value of your labor, unfortunately, that's going to necessitate a massive monetary response from the Federal Reserve and other global central banks who are trying to maintain an inflation target. So that's number one. That's why I think Bitcoin is uniquely positioned to do very well in the age of AI. Number two, artificial intelligence is destroying software modes left and right. And what do we talk about in the middle of this podcast? The fact that Bitcoin is very tightly correlated to software equities. but it cannot be disrupted by artificial intelligence. So AI is breaking down software moats. Eventually, it's going to break down moats of other companies. It's going to be able to build one or two person multi-billion dollar companies. So a lot of the value that's in equities right now will be eroded. It will be disrupted, and that capital will have to move somewhere. It'll move to two places. First and foremost, the disruptors. So the Metas of the world, the NVIDIAs of the world, the AMDs of the world, the picks and shovels, and also the front ends that consumers interact with as far as AI is concerned, the data center companies. Um, that capital will flow from the disrupted to the disruptors, but it will also flow to the assets that cannot be disrupted by artificial intelligence, like gold, other hard monetary metals, and Bitcoin, right? And so for those two reasons, right, number one, the deflationary impact of AI and the inflationary response that will be necessitated after it, and number two, the fact that it is so disruptive and the capital will have to flee elsewhere where it can't be disrupted, leads me to believe that artificial intelligence is like obviously a massive productivity tool, and it's going to change the way that we work, and it already is, but it's going to change the composition of asset markets forever. And I don't think enough people are talking about it.
So it sounds like you would agree, you would think that the run that we've seen in AI related equities is sustainable then. I see a lot of people saying that this is a bubble, and it's just a matter of time until it pops. And we're basically right back in 1999 scenario with the internet. And I'm not sure that I have that perspective, and it doesn't sound like you do either. You
No.
feel like this industry is really only just getting started, and the amount of money that's about to flow into it is substantial,
Mhm.
especially given the money printing that's coming, that we've all that we've described
Yeah.
through this. I think I saw a stat. It was something like 12 stocks in the S&P 500 are at all-time highs, and everything else is significantly below all-time highs in the S&P 500. And so if I had to imagine, those 12 stocks are all AI infrastructure related. Um,
Yeah.
so do you feel like this is sustainable and we're not going to see the bubble pop in AI then?
Yeah, no, I do. I think this is sustainable. It's funny, Mitch, like every single time there is a bull market, people want to be the next Michael Burry, right? They post pictures from the big short and they say, I'm right. Everyone's going to be wrong, blah, blah, blah. I'm early, but I'm not wrong, whatever. This
Yeah.
time they are very wrong, right? And the reason is they're actually revenue generating companies. There's huge revenue and there's huge forward revenue. Obviously, they're trading at many multiples to their earnings. But the fact of the matter is, like, equities have always done that, and that's what they always do, and that's what they've done for the last decade, 2 decades, 3 decades plus. The dot-com bubble, and I hate this comparison so much. The dot-com bubble was dominated by a massive manic investment wave into names that had no value whatsoever. Pets.com. What's the value proposition? You can buy pet stuff online, right? And just a million and one, and that was valued at like $1 billion, $2 billion, $10 billion. I don't know, just crazy, insane valuations. But the valuations, number one, are much more measured, and the earnings are actually there, right? We're literally at such a level where we do not have the compute to be able to satisfy all of the demand from retail, from businesses, from governments for artificial intelligence. That is that is literally the opposite definition of a bubble, right? There is not enough supply to meet the demand right now. And so the valuations are fine. The earnings are there. I don't think that's going to stop. We're living through a productivity regime change, a revolution, if you will. And it looks like a bubble when all you've been used to for the last 2 or 3 years when it comes to major asset price appreciation events have been bubbles. So I understand why people think that. But if you actually go a layer deeper and stop being very myopic, very surface level, you'll recognize that, wow, this is actually like a once in a generation opportunity. So that's how I view it. Obviously, some names might be overheated, but we're not there yet. We're not even close.
Fair enough. I can appreciate hearing that, considering we have an over 50% allocation to semiconductors currently in our Fluvius portfolio strategy. So that's been a
Right.
very good play for year to date, and for much of 2025 that we held them as well. So we'll see if that continues. Hopefully it does. We get some clients reaching out like, "Hey, maybe we should take profits now." So our entire strategy is systematic. So we're following the signals. We're not intervening because the
Mhm.
signals have proven to work. So I hope you're right, and I do think there is substance here. I mean, for us, we're really looking at the future, the near term future. as taking advantage of the AI infrastructure build out and the reshoring of industry in the United States. The electrical infrastructure that needs to be built. The U.S. really has to rebuild industry if we want to be successful heading into this next 10 to 20 years.
Yeah.
If we can't produce enough power, we're going to lose the AI race to the rest of the world, and that just continues to hurt our position on the world stage, if you will. And I don't think Trump wants to lose. So I think he's going to do whatever he needs to print enough money to get that stuff built out. We'll see how long it takes, though, because you can't print that stuff. You can print the money to maybe to buy it and get it going, to fund it, but you still have to build it. So we're positioned for that trend to continue, as well as defense spending. So we'll see what happens, going into the future here. But I'd like to transition now, out of the macro talk and just talk briefly about Horizon. Obviously, you're head of growth at Horizon. It's been around for a little bit now as a useful tool for folks to transform their home equity that's laying dormant right now, and transform that into Bitcoin. And based on what I was reading on the website, maybe any other assets as well. But obviously, the purpose is Bitcoin. So could you just give me a high level, simple overview of what the process and mechanics look like, and then I want to discuss the economics of it after we kind of get the structure built, understanding of how it works.
For sure. So I appreciate you bringing it up. Yeah, Horizon is a really neat tool. We've helped dozens of homeowners to date. We've been around for about a year, convert their idle home equity into Bitcoin. Typically, this is, we're talking to higher net worth individuals, but we work for as homes that are as little as $300,000. It's a crazy word to say in 2026 that that's a low priced home, but here we are. Basically, the process works like this. So you technically can buy any asset, but we built this from the ground up for Bitcoin, and I'll explain why once we get into the numbers. At a high level, what Horizon allows you to do is to sell a portion of your home's future value in exchange for tax-free cash today to purchase Bitcoin. So what does that mean? Well, to give a concrete example, effectively, let's say you've got $1 million home. You decide you want to sell 10% of that for BTC today. So you take 100 grand out, you buy a little bit over 1 BTC, 1.25 BTC. In exchange, you get the Bitcoin tax-free. You throw it in self-custody, do whatever you want with it, get a Bitcoin-backed loan, or you can take the cash and go to Vegas. It's not ideal, but you can certainly do that if you'd like. And then in exchange, we get a 10% lien position in the home. As the Bitcoin grows, right, whether your base case is 20, 25, 30, 35% a year, over the first 8 years of the agreement, our share in the property will grow from the initial percentage to the percentage by a factor of 2.25. So it'll grow year after year, as you can see right here, from 10% incrementally all the way up to a 22.5% stake in the property at year 5, or after year 8, rather. At year 8, it remains there, right? So you can see that in the home equity ownership column right there in the middle. On the right side, you see a column that says annualized payoff cost. Now, this is something that we decided to implement for a couple of reasons. What annualized payoff cost means is it's not an additional cost. With Horizon, there are no monthly payments, there are no term limits, there are no interest charges. It's literally our stake in the property that grows marginally over time. And then that's it. After year 8, it remains at that upper limit. And then whatever percentage of the home's future value it is, that's the payoff. That's it. The annualized payoff cost is meant to illustrate what this looks like compared to other solutions. So number one, you can see that after year 8, there is a declining cost structure. If you do this for 30 years, you can achieve sub 6% financing, right? Assuming the home is growing roughly in line with the national average of about 3% a year. So that's number one. It sort of lines up with the Bitcoin ethos of buying and holding. So if you're in your home for a long period of time, this is a solution that could be ideal if you believe that Bitcoin is going to, at the very least, do more than 6% a year over 30 years. And number two, we structured this in such a way where you could see over the first couple of years, it caps out at 12.99%. Now, relative to mortgages, relative to HELOCs, that's crazy expensive. I wouldn't touch that with a 10-foot pole. However, the reason it's there, right, and not 15% or 17% or even lower is, number one, over a multi-year time horizon, right, whether we're talking 2, 3, 5, 10, 15 years, as long as Bitcoin's been around. The compound annual growth rate of its 4-year moving average has never dipped below 30%. So 12.99%, less than half of that. So as long as your base case is Bitcoin will continue doing what it has been doing over however long you're remaining in the house, then this is a solution that could work for you. If you believe that at the very least, Bitcoin is going to outpace 13%, this could be a solution for you. And so basically the reason we put 12.99 in there is to make it so that it's very unlikely that using Horizon, you will be in the red if you remain in your home for enough time to ride out any potential Bitcoin bear market. That said, it's not ideal for homeowners who are staying in their home for like 2 or 3 years or less, right? Reason being, number one, you need to give the Bitcoin time to compound. And number two, bear markets can be terrible. They can really suck. And so if you enter into a Horizon agreement, you buy Bitcoin, you give Horizon a lean position in the home, and then all of a sudden, Bitcoin tanks 50% and you're planning on moving next year, that could throw a wrench into your plans, right? And it could ultimately leave you in the red at the end of the deal. So that's basically, I know I went into a lot of detail, but that's the way that Horizon works. And I generally advise folks who aren't staying in their home for a while to consider other options. But if you're bullish Bitcoin, if you look at these numbers here and you think Bitcoin's going to outpace that, you don't want to add an extra monthly payment and you're going to be in your home for 10 years plus, this is definitely something to consider.
Makes sense. So effectively, just to make sure I'm understanding correctly, you hope that whatever you take that money and you buy Bitcoin with it, you hope that Bitcoin's CAGR is going to be higher than 13%. Over your time horizon, whatever that might look like. And so you're effectively selling a portion of your home equity, and receiving the payment for that. Is that fair enough? What's happening here? Because
Exactly.
it,
Yeah.
it sounds like the differences between I mean, my mind obviously goes to, well, why not just pull out a HELOC and do the same thing?
Mm,
Obviously, then you're going to have
yeah.
interest payments along with
The
that.
neat thing is that
Um,
this is complementary to a HELOC. You could take out a HELOC as well as a Horizon agreement. So you're exactly right. Like the way to think of a HELOC or a mortgage is you're borrowing against your property. The way to think about this is you're selling a chunk of your property in order to buy the asset. And instead of interest, that chunk grows marginally over time to a defined upper limit. So like,
yeah.
imagine like investing your kitchen in Bitcoin, I guess, or like investing your bedroom in Bitcoin. That's effectively what you're doing.
Oh, that's funny. So what's worst case scenario here then? It seems like
Mhm.
you guys are not custodying the Bitcoin. So let's say somebody were to sell 10% of their $1 million home, they get 100 grand, they put it in Bitcoin. They're in charge of securing it. Maybe worst case scenario is they lose the Bitcoin.
Yeah.
Sounds like, or Bitcoin
Yeah.
goes to zero, which
Exactly.
losing the Bitcoin is more likely, in my opinion, than Bitcoin going to zero.
Uh,
But so that's worst case scenario, and then you guys are an equity owner up to 22.5% of the home. So is there any payback deadline in that scenario? Let's say I did just lose all the Bitcoin, but now you guys still own a percentage of my house. We can just continue to roll, and then whenever I sell, I give you this percentage of the proceeds, or
yeah.
how does it work?
That's correct. So big risks with Horizon, to be absolutely transparent. Number one, if you stop paying your homeowner's insurance or your property taxes or the home goes into foreclosure, then that would end the agreement, right? Pretty standard stuff, like with any other mortgage. We're not a mortgage, but same rules as your mortgage. Also, there is no risk that Horizon going out of business or even our financing partner, Cornerstone, going out of business, that wouldn't close out the deal. So your terms would remain valid at whatever company decided to pick the agreement up. So your home is never at risk. The Bitcoin is also never at risk. You're never going to get margin called or liquidated from either asset. So that's good. So the only risk with Horizon is that Bitcoin underperforms or goes to zero. So worst case scenario, let's say Bitcoin only does 10% a year for the next decade and your home does 8% growth every year for more than a decade. In that situation, you would probably be in the red, right? It wouldn't be ideal. That would be worst case scenario. So basically, if Bitcoin goes to zero, obviously that's a pretty bad event. The rest of your Bitcoin stack would be at risk too. So it's not a Horizon native risk. The chief
Yeah.
Horizon native risk is that your home does extremely well and Bitcoin does extremely poorly for the duration that you're living in the home. That's the big risk. As far as like a term is concerned, there's no predefined term in the Horizon contract. So you can enter into this with the intention of staying in your home for a decade, but then let's say, baby comes along that you weren't expecting, you got to buy a new house. Then you could settle up at any time, no prepayment penalty, right? Or vice versa. If you're planning on doing it for a short period, you decide to do it for a long period. There's no predefined term in the contract, so there wouldn't be any prepayment penalty. As long as you're living in the house, this can ride out. Bitcoin can do its thing in the background. Um, if Bitcoin has a huge bear market, right, then you can keep the Horizon agreement in place and then wait till you sell your property in order to pay Horizon down. As far as a maximum term is concerned, we actually created a maximum term of 130 years specifically because we wanted to make it longer than basically any human has ever lived before. So that technically this is a product that you could use for life, right? You could have it on your property until you sell, pass away, or pass it down to your heirs. If it's not already in like a living revocable trust,
Sure.
then you can keep this thing open.
Got it. So when you're saying you could settle up at any time, then is that requires a an appraiser to come out
Exactly. Yeah. So on the
based
front
on.
end, we order a third party appraiser. We can't do it ourselves. Following the 2008 financial crisis, I learned this. Oftentimes, mortgage companies would literally send out their own guy to appraise the house. Crazy that that was ever legal. But now we go through a third party management company, appraisal management company. And then on the back end, whenever you decide to settle up, whether it's selling the home, we would just take the amount that it sold for, as long as you didn't sell it for $1, as long as it's around fair market value. Uh, and then we would take our share from the sale of the home proceeds. Or
Got it.
you would just order an appraiser at any time, say like, hey, still living here, but I want to settle up. And then they would determine the value of your home. We would take a look. If it's before 8 years, we would run a calculation to the day of what percentage we owned. If it was after 8 years, it would be the maximum ownership that's predefined at the start of the contract.
Got it. Makes sense. All right. I appreciate that context and I appreciate you being honest about the risks. Just because, for me, that's kind of a framework that I love to think through things whenever I'm advising clients around their financial plan and making these kind of moves. What is worst case scenario here is a good frame to think through just so that we can be prepared, if that some for whatever reason does come true. So awesome. I love it. I think it's very innovative, and I understand why you'd want to be a part of a company like this. Really pushing the boundaries of the industry and offering new tools for Bitcoiners to get their a large portion, a lot of times, of their net worth out of their real estate primary
Mhm.
residence in a way where it doesn't put them too much at risk, we'll say.
Mhm.
It's not like you're refinancing a house and all of a sudden you have a brand new mortgage with a huge mortgage payment when you
Yeah.
didn't have that all of a sudden before, or you have the HELOC where interest is compounding over time against you and you got to make payments on it. So love it, man. Any other thoughts as we wrap up? I mean, I definitely want to give you a chance to share where people can find you. Best place to follow your content. I know I really love watching your YouTube videos and really appreciate your the information that you provide and just your voice in the Bitcoin community. So where can people find you? And if they want to maybe reach out to Horizon, where would they do that?
Absolutely. Well, Mitch, thank you so much for having me on. This was probably my favorite show that I've done in the last several months. So, really appreciate it, man. And I hope the audience found it valuable. If you want to see more of my content, follow along. If you're watching this on YouTube, just search Joe Consorti in the search bar up there. Or you can search Joe Consorti on Google. Go to joeconsorti.com, see all my videos and all my other offerings, book one-on-one sessions with me, etc. But instead of booking a session with me, I'd highly advise you book a session with Mitch. He knows much more about what he's talking about, and he can help you much more than I can. But yeah, those would be the best places to find me and follow along.
Appreciate it, Joe. You have an exciting time coming up. Congratulations on the new baby.
Thank you very
Maybe we
much.
can reconvene after you've got a little one here, and we can get an update on how the family's going. So
We can
thanks
do
for
it
your
in
time.
person. I'll call it a work trip, and then our kids can have a play date.
There we go. Awesome. We can go on a hike in the mountains. Love it, man. Appreciate your time today, and hope people found it valuable. So thank you.
Thanks, Mitch.
Thanks for sticking around to the end. I greatly appreciate it. I'm Mitch, the founder of Strong Wealth, and we help Bitcoiners retire early and stay retired without sacrificing their peace. If that interests you, head over to strongwealth.net to learn more about us and our services. And don't forget to subscribe to the show. We really appreciate you watching all the way through. I'll see you in the next one.